the decision to build out a system versus a product, in my view, is the best decision that we did as a founding team right in the beginning. So you say, let's keep a wider net. Let's try to think about things in a very modular fashion. So an example of the modular was that we built.
Welcome, builders, to How Would You Build It? The podcast that dives deep into the dynamic world of startups and product creation right here in South Africa and Africa. This show is more than just interviews. Every week, we sit down with the brilliant minds to provide a masterclass for building digital products amidst the challenges and opportunities unique to our continent. From seasoned founders to dynamic product managers, we uncover the unique stories and strategies behind some of the most innovative digital products being built. So for all the aspiring founders and product builders out there, you'll discover that each episode is a wealth of practical wisdom and local and actionable insights. Make sure to subscribe or follow wherever you listen to our podcasts and connect with us on social media for even more content. Now, let's dive into today's episode.
So where does the name LayUp come from, Andrew?
So obviously, so I'm going to start at the top there. So obviously it's got a direct relation towards the term labor, and we're the first company to digitize labor in South Africa. The first company to take it into e-commerce environment and then digitize it in store. But the name actually originated from the golf course. And I was just laughing, if you play a few rounds of golf, there is some nice golf courses there. But to lay up in golfing terms is to actually play the whole a little bit more responsibly. So you can go and say it's a par 5 and you can hit your drive down the fairway and you can take out your next big club and go for the green and 2. And most times your average golfer is either going to hit it out into the woods or hit into the water, and then is going to be negatively impacted by that risk. And what LayUp really is doing from a concept point of view is saying, hit the ball into the fairway, take your second a little bit closer, and then your third onto your green, and you'll be walking off with the least par. So the methodology of paying over time, being responsible, being sustainable, and making sure that you get that par or birdie at the end of the day is where the concept and name was originated.
I love that, Andrew, but I know nothing about laying up. My friends normally don't come to see me lay up when I play golf, so I'm more of a tiger line kind of guy. So, but lay-by technology, I mean, it's not something that a lot of people, at least, in the people who grew up a bit more privileged or wealthy understand. I mean, they understand credit cards. So maybe as just as an introduction, like what is lay-by? Any insights as to where it came from? What has popularized it?
Sure. So it's an age-old way of paying. It's heavily entrenched in the African market, and for a few reasons. Other places around the world, it's been termed layaway, the likes of the States and Europe. But effectively, it's an interest-free savings plan that allows someone to secure the goods today with a small down payment, referred to as a deposit, and then they have a period of time in order to pay toward that item. Only receiving the item once paid in full. And the concept was developed around the 1950s, coming out of World War II. So there was, a down economy, people were rebuilding, and there was not a lot of available cash flow for consumers. So people would save towards that washing machine or retail item over a 6-month period and be able to collect it once paid in full. Where it was really got a lot of traction in the African market is that during the apartheid era, people couldn't get access to credit. So this was a great way for people to save towards an item with not having to go through any type of credit facility or credit KYC process. So that's kind of the origination of the payment method. And still in today's day and age, it is a widely used payment method, still very traditional, manual, and we're here to hopefully digitize that and improve it.
Awesome. And I mean, you say hopefully, but you're already doing it. You made a post on LinkedIn earlier this week about launching in the iStore. We all know how expensive those iPhone products are, and there's no way that you can pay them off on an average South African monthly salary in one shot, if you have other things to pay. So how's that been going?
Fantastically well. So we've launched in the Mapanya Mall in Soweto, and some data that I gathered was that we're looking at roughly 1.7 million people just in the Soweto area. Majority of consumers in that area do not have available transport. Therefore, they're using the malls in those areas to go and shop in. And generally, LSM's 1 to 6. So you're not going to see a lot of consumers there qualifying credits. And this is now a solution that gives that consumer access to a product that is a premium product that so many people love and want to use. You can think of a young designer, or you can think of someone that's maybe interested in photography that's wanting to get a premium device like an iPhone or a laptop and is unable to do so when they walk in and they see a ticket price for 40,000 Rand.
Yeah.
With the LayUp solution, they're now able to create an interest-free payment plan through no credit checks, no barrier to entry, and no declines, and allow their consumer to put the available cash that they have on hand as a down payment. And then they have up to 6 or 12 months in order to pay towards that item. Of course, that consumer is able to complete at any given time. So one of the things of why we're digitizing it is once that customer's activated that payment plan, they get to make those subsequent payments for the comfort of their home. They're not required to take a taxi or get transport back to the area where they activated the plan. They can actually make all incremental payments from the comfort of their home, being notified on a monthly basis as they pay towards that item that they so badly want.
And that's awesome, right? Because so many people have bought expensive things like iPhones and iPads and Apple Watches on credit and then getting themselves into difficult situations. Whereas this, we're saying, okay, great, you can have this product. Let's do it from your way. Let's do it the responsible way. By the time you actually get the item, there's no date on it. You can.
Yeah, spot on. And what we see from the unit economics is that you increase the customer lifetime value through that option. Because the consumer is using their cash flow on a monthly basis that is not going into unwarranted debt, they're then able to look at the next purchase either during or after they finished that first initial payment plan. So there's a lot of accessories and nice cool things that one can add, and you can have multiple payment plans going at one go. So the launch has been a positive, a great early start, and we'll hope to see that continue across more stores in the future.
That's awesome. And I think you touched on something important. It's not only the benefit for the consumer of being able to do this. There's a lot of benefit to the retailer as well. If you go in store to make the payment, then obviously your solution allows you to do that online as well. But if you go in store to make a payment, I can imagine a place that sells a lot of smaller, low ticket items. The people might have cash on hand to pay some of those items. You have footfall coming to your store, for the duration of this contract. And almost footfall with intent because they want to go there, they want to make a payment and get closer to unlocking that. So that's the first thing. And the second thing is obviously the predictability, right? So they know they're going to be selling iPad 2 months from now if the payment plan, plays out the way it should be, which then gives them some data points. Are there any other benefits that they get from this?
So we've got a huge host of configurable settings for the merchants. And one that you just touched on there is when do you need to start actually ensuring that you've got that stock item and that it's available and it's to that color and size. We have a notification setting that will notify the merchant of when a customer is a certain percentage of the way there to their payment plan. Let's call it 60% or 80%, whatever the merchant decides. So it's a very cool way to be notified, and then I can, as a retailer, start preparing that item so it's bagged and tagged and ready for pickup or delivery when that customer completes that plan. Additionally, what we've got is that we've when we onboard a merchant, they get access to a CRM portal that CRM portal gives them real-time data as to what's happening. And we've got lots of different data points. So plans for that week, revenue for that week, number of cancelled plans or amended plans, and information that allows them to better be able to manage this. In so many places around the country, retailers and businesses are still using tax invoice books to manage their labor. So now one could imagine if that book goes missing, what do you got as a reference point to actually know who's paid what and who's ordered what? So immediately, just by digitizing and creating a digital format, the merchant has got real time, it's mobile friendly. The director of a company can be on the run and he can be able to see real time what's going on with their store's turnover.
Awesome. Love that. So Andrew, your business is quite unique in the sense that your customer is the retailer, but obviously, they have a customer who actually needs to end up using the product. And a lot of people would say it's a B2B2C. So what have you learned in a B2B2C space? Like, what are there things that you could do to drive consumers in the iStore to actually be more keen to try this out? Like, at the end of the day, the success of your product really is dependent on how an end customer, which you have no relationship with, actually use this product. So what are some of the things you've learned to drive adoption?
I start laughing there because my immediate response would be, don't do it. Don't build a B2B, B2C company. Super complex for many reasons. Who do you value more is the kind of thing that we have a lot of debates around. Are we valuing the merchant? Are we in the customer's corner? Who is the person that we champion? And then it comes down to finance, really. So where does your marketing budget get split and stuff like that? So it isn't an easy project, but I think this project itself, because there's in the model, we're creating access and we are servicing a consumer that previously was locked out of the economy, there's a big impact play. Is there a way that we can actually create financial inclusion? And that's our purpose statement, is really trying to find a way to serve a wider market and bring those consumers to the retailer so that we can increase their sales and grow turnover, which is the B2B, B2C part. So a lot of learnings. So we have scaled quite nicely. We've got quite over 200,000 users over the last 2 years, roughly 2 years. And with that, we now create a platform for new merchants that come on to get access to this community of consumers that want to save now and buy later. They're not looking for credit options. They're looking for alternative options. And if we can bring those brands to those consumers, it's a great way to now start widening that market and servicing more consumers. I think I might have mentioned in our previous engagements, but I say to retailers, and this can be e-commerce or in-store retailers, that if you're only offering full payment and credit, where are your customers going if those are the only two options? Because if you look at the active credit users in this country, you're looking at around 6.5 million active credit users versus 25 million consumers that can't access. So it just means that you're leaving a lot of money on the table when you're only providing two options, cash and credit as your way to pay. Now that we've kind of got big enough, I feel like we're able to now use that as a way to actually go out and convince more businesses to come on board and get access to the solution. So we do quite active marketing. Yeah.
And it's interesting because, I mean, if you think about it, like the argument for not going after the 25 million would be, well, they've got less disposable income. But because it's 4 times bigger, even if they only have 25% of the disposable income, it's still a market of equal size and equal opportunity that can be served. Fascinating.
Yeah, totally.
So Andrew, in this affordability space, when it comes to buying things, there's, the buy now, pay later thing. it's become quite big. Like if you on Takealot, I mean, I think it's Payflex is one of the options, and there's a few other ones
Yeah.
going around. And globally, some of them have crashed and burned. I see even on Vodacom, I can get time advance to buy myself Dunkin' Donuts, which I find fascinating. Like it's literally a way to get credit to buy donuts. Like this is bizarre.
Yeah.
Anyway, what
Really.
I mean, what was your philosophy around it? Like, why did you take the approach of lay-by as opposed to buy now pay later?
So, yeah, so I guess it was that macroeconomic stat that I gave earlier around the market size of active credit users and was not. I think also the need and kind of vision of creating financial inclusion, creating something sustainable. I've viewed that the world didn't need another credit option. If I look left or right, you can get credit from 30 different providers. And if your bank is not willing to give you credit, then you are high risk. Because the bank that you bank, then the bank that is walked this journey with you through most of your life is going to know the data points on you as a consumer, and it means that you're going to alternative players, meaning because you've maxed out your credit options with your service provider. So there was that. There was the vision. It was why, like, we always start with the why. What is your why? What is the reasons for doing that? But I like to define it in kind of two different buckets: prepayments versus post-payments. So anything in the post-paid world would be your credit options, and in the prepaid world would be what we are doing. And if we look at the postpaid opportunities like buy now, pay later, then you're going to have those consumers that are going to want that immediate gratification and want to go down that option. But when you look at prepayments and look at the need of how many consumers cannot access them, then the market looks very interesting, and it's something that is totally untapped. So if we can find and continue to find ways to better serve those consumers, to create longer lifetime cycles with those consumers that ultimately get that consumer to a place where they've learned to systematically save for something worthwhile on the horizon, as opposed to taking in credits and going into unwarranted debt. We've done our job at the end of the day. And without telling you too much about our future roadmap, there's some pretty exciting things that we hope to be able to build out in the coming months and years.
Awesome. And there's another kind of lay-by, if you will, which is quite popular in Africa, but it's like a peer-to-peer lay-by called the stokvel, or more commonly known as the stokvel. I mean, this is your tech can facilitate the stokvel as well, right?
Yeah, spot on. So the way that we've decided to approach building the tech stack that we've done was to always refer to it as a system and always go back to that. So like that was our source of truth, is that we're not building a product, we're building a system. And maybe that's has been part of the process of learning and building infrastructure and getting some heavy kind of bank grade stuff done. But it's got us to a place now where we're able to diversify across various prepayment services. And Stockfold is a perfect example of that. So what we've done is we've diversified into subscriptions, Stockfolds, pre-orders, and part payments, as well as the digital labor. So if our business wants to use us, we give them the flexibility of opting in or opting out on whichever payment option they want to be able to serve a market that previously wasn't visible. And by doing so, that's going to add anywhere between 10 and 30% additional consumers and revenue to that business, which is exactly what a lot of businesses are trying to do. They're consistently trying to grow their market.
Okay, interesting. And do you think, I mean, from my understanding, like the biggest challenge for Stokvel not going digital has always been, transaction fees. Like how can one overcome that and make it feel more like cash?
So, look, we've done this through multiple different ways. Is that part of that infrastructure layer that we've been building in the system was we integrated with multiple ways to pay. So we've got card, debit card, credit card, instant EFT, debit order through debit check, and cash payments. So our system can record cash payments if you were receiving that cash payment yourself, and then you are the one that's recording and putting that information in. Or we've partnered with Payat, which has got around 276,000 cash acceptance points nationwide, where a consumer can go to that Pick and Pay or ShopRite or Boxer and make a cash transaction in that environment. So what we do through our stockpile products is that we go and we enable the business that is wanting to offer digital stockpiles or offer a stockpile. And instead of them having to manually reconcile and monitor the stockpile payments, our system does that all on their behalf. So it creates a journal entry. It's real-time information. It gives the consumer the ability to pay anywhere across the country, so they can pop back to Zim or a neighboring country. They can still continue with their stockpile in that way. You're not going to have a situation where in December, suddenly one member is going to run off with the cash, which can happen a lot of time. So it becomes much more secure, much more safer. And that's where the end consumer is really starting to love our brand, is that they see us as a trusted payment service provider that is that they know that they're going to get their money or their product when using our service. So still in the early stages. I'd like to say the stockpile products in MVP stage still. But we've got some very exciting partners that we're working with some very big stockpile books that we hope to innovate on.
Awesome. That sounds exciting. Tell me, Andrew, I mean, this is all part of something that you call variable recurring payments, right? And to the man on the street, they might go, I don't understand the tech or the fintech rails, so why is that even a thing? Like, maybe expand a bit, like what is variable recurring payments? Why is it kind of unique in the sense that not a lot of people are doing it? I mean, you guys are some of the first ones really pioneering it. And like how maybe some use cases of how businesses can use this and what they can use it for.
Sure, yeah. So VRPs is a banking term that's coming out of the banks and using open banking. And the green shoots of what that is in South Africa is PayShop. So PayShop is using real-time clearing, instant payments in order to be able to facilitate a transaction back and forth instantly as cheaply as possible. So because we are B2B, B2C, as we discussed earlier, we are always looking for cheaper ways to be able to collect on behalf of that merchant so that they can benefit on a lower cost transactional fees. And the faster that we can get them the money, the better. So account-to-account payments through VRPs is where the market, I believe, is going. The ability to be able to set up a mandate, not through like a very clunky debit order process, but through a PayShop type of rail that allows a business to attach a mandate to an account and be able to collect recurring. And the use cases for this would be subscription type products and services. And of course, in our world, everything is recurring. So digital labor, pre-orders, all the payment methods that we've developed, we want to apply account-to-account variable recurring payment offerings. Now, the interesting thing there is that in order to actually achieve that, you have a lot of configurable settings and rules that need to be set up in order to get that action. And what we've developed is we are the enabler, the middleman, the TPP, the third-party payment provider between the merchant and the consumer. So we now give a platform for a merchant to be able to set up those rules so that let's say it's an insurance company that's doing funeral policy collection. So they need to collect recurring as well. And there's a bunch of rules and settings that need to be applied in that way. What we are then doing for that business is that we're providing a cheaper, better, faster way for them to be able to collect recurringly from their consumers, and then giving their consumers a very convenient and user-friendly way to manage and make those payments, so that there's a willingness to want to actually pay. If you are just setting up a token payment via your card and you don't even get notified, the next thing $2,000 comes off your card, you don't have the best user experience. But if you're notified prior, if you can go into a platform and you can see all this information, it's a perfect way for the consumer to willingly make those payments and be up to date on it.
Yeah, so typically, I mean, if we speak in the lay-by world, it could be, I'm buying an iPhone and I want to pay it off over the next 6 months. And the cost of the iPhone is 18,000 rand, so I typically pay 3,000 rand per month. But then 1 month, there was an emergency and I'm tight on cash, and now I can say, cool, let me pay 1,000 rand this month, and I'll pay an extra 500 for the remaining 5 months. It allows you to be able to do that.
So we already do that. So we already have all that flexibility, so we can allow it to amortize. We don't have to allow it to amortize, like in the funeral insurance example. We can't allow payments to amortize, means that you're not actually covered. So those are where I bring in the settings. The ability to then collect recurringly from account to account payments is a little bit premature. That's not available yet, but we hope that PayShop is going to launch the business to peer functionality in the coming months or within the year. And that will allow us to get onto those payment rails and actually then take that product to businesses to say, here we go, here's a way that, one, we're going to be able to collect recurringly for you on scale, but we can do it cheaper, better, and faster. And you'll get your money instantly at a lower rate and at a more kind of superior collection rate, which is exactly the concept of what VRPs are. And I'm very excited about that, because I think the use cases don't just stop with what we've developed at the moment. The use cases really become a much wider opportunity that one can tackle.
And can we just take a moment and celebrate how awesome PayShop is? I mean, I now regularly use it. I use it probably once a week at least. And in fact, yesterday, a friend phoned me and he was in a difficult spot and he needed money instantly transferred. And, I was pay shopping it from FNB to Capitec, and, you can go. It's still early days, but almost no one knows about it. Whenever I tell someone I'm going to pay shop you, they're like, what are you talking about?
Did I read the other day 9 billion has gone through? That's in year one. Something like that. So I don't think they've done too bad off year one, but I know the guys quite well there, and it's really incredible. Look, it is off the back of a global concept. You kind of see this happening around the world. It's referred to as UPI in India. There's
Brazil is a big one.
Brazil is a really big one. I forget the name of it, but you can start feeling a momentum in the financial world or banking world that this is a strong pull towards being able to collect payments in a more affordable, real-time manner. And the problem what you hit with card, and card is still definitely the preferred payment option on e-commerce, but that may shift with VRPs coming into the market. Like, if I'm going to buy from Takealot regularly, similar how I can load a card and have that card stored, can I do that with an account so that when I come in, I can just click one click of a button and that money has gone to Takealot at a fraction of the cost and in real time. And now, in real time. So it just totally overshadows, I think, the other payment options. So we want to kind of, especially where we are as a company and how we are focusing on innovating in the space, is we do all things recurring. So we want to be on as well. We can ignore the once-off payments because we don't need to compete in that space. We want to find use cases and innovate and enable businesses on things that they need to collect recurringly. But I think PayShop's a phenomenal product, and I'm very excited about where that's going to go. And I think it's going to happen very quickly, the transfer.
Yeah, and I think also, from an economic inclusion point of view, right? So, how I typically use it is for service providers. So someone would, let's say you get an electrician to come and do a job, etc. A lot of these guys are like living hand to mouth kind of vibe. So, they want you to pay them cash now, right? And since post COVID, I mean, I don't know when last I saw my wallet. Like, I've got tap to pay on my phone. I just don't use a card anymore. Like, so
Yeah.
there's almost
Yeah.
been a step post COVID away from cash on the one side, and on the other side, it's almost as if people are left behind, because if you can't receive a tap to pay payment, then well, getting paid becomes really tricky. I love how pay shops really just bringing forth economic inclusion, and bringing more people, bringing the ability to get instant payments for 0 to no fees, I think is great.
Yeah. It's interesting. Just on your cash comment, there's definitely been good headways made in digitizing cash or removing cash from society, but we've kind of looked at it a different view because of the customer that we serve, and it's still cash is king. The term cash is king is still definitely there. So we've kind of looked at it as, instead of trying to remove it and make it kind of a difficult process for someone to want to pay in cash, rather create convenience on how they can make those payments via cash. And by doing so, that we guide the user down a digital journey that after 2 or 3 payments, there's now a willingness to move into digital because it's more convenient. Instead of blocking them at the checkout process to say, these are your only payment options. And I think by doing stuff like that, you're going to start seeing more of a transition. When you just see a big sign on your door that says cash not accepted here, you're immediately turning away that customer. And there's still so many consumers that still need to become, that need that education gap in order to start using and tapping into the likes of PayShop. And it's going to take, 1 or 2 transactions and test transactions like that, and that customer will be hooked and see the convenience of it and receiving that when online.
So Andrew, you touched on experience, which I think is extremely important for fintechs, right? So in your experience, how big an impact does friction have when it comes to drop off for people completing, and how do you go about friction and how you build it?
Huge. I think so much relies on the user experience of what you're developing. And we are constantly reiterating on that. Like, we constantly say, remove the steps, have as little steps as possible to go from start to finish. So that you create that frictionless experience. And it's a lot trickier in reality than just doing it. But it's reiteration. Iterate as quickly as you can. I'm referring to myself as more of a startup that is growing in the market. So we have versions 4, 5, and 6 already kind of in the design pipeline, waiting for stuff to kind of be done and that we can get that to market. So it's something that we're constantly working on a daily, weekly basis. And I think there are lots of tricks. I mean, you've got things like Hotjar, where you can see how users are going through your checkout process. That's if set up correctly, will give you touch points, heat maps, and then you must analyze that regularly, and then you look at briefing that in and improving it. And it's funny that you asked that, because we are in the process of doing that right now, based on 12 months worth of learning, and it's not going to stop there. It needs to be version 2, then version 3, like I say, and constantly being pushing the boundaries of making it as frictionless as possible.
And I think, when it comes to fintech specifically, there's some unique things when it comes to UX, right? Because on the one hand, there's some regulatory things or, processes and stuff you can't get away from, like you need to do certain steps. On the other hand, you're working with third parties, and you have to do
Yeah.
integrations, etc. And then you have your own experience. Like, I mean, it's not as I think the big challenge for fintechs is you can't just design the experience you want. You sometimes are influenced by these outside factors. So
Mm.
what would you say is good advice for anybody building in fintech? Like any processes or way of thinking that you guys have discovered that really helps to think a bit outside of the box and not to go, you know what, this is the way our Fika, and I know you guys don't have to do Fika, but this is the way Fika
Yeah,
works.
sure.
It's always worked that way. Let's just do it that way. Like, how do people get
Mm.
themselves to think outside of the box?
Yeah, I think one of the points that you said there was using third-party providers. Make that selection one of your most important decisions that you make, because when you start and how you're going to build off, when you're an enabler like us, is critical. So choosing that service provider, because you're very right. You don't have control once it gets into the service provider's environment. Is it functioning? Is it working? Is it buggy? And are they actually reliable to provide what you need? So I think we started off that in the conversation. Our host-to-host integrations, our payment methods that we're using, and the partners that we're using, those were very selected providers in the market that we deliberated on a very long basis, and it's helped us to grow. So as they've grown, we have grown.
Mm.
Yeah. Second point that I would add would be yeah. Spending again, going back into spending the time before you can actually just get to market. They always talk about how important planning is before you actually hit the ground running and start developing something. I mean, you know this yourself, coming from that space, is that I'd rather spend double the amount of time in a planning process and refinement than trying to rush to market. And I think with a lot of entrepreneurs out there, we're so eager to get to market. We're worried about competition. We're worried about the timing of it, and like the timing is now. Most times, when you think that the timing is now, you're probably too early for the market. And my advice would be just to rather spend a little bit more time in the planning sessions and make sure that you've made all the correct decisions before rushing to market.
And I suppose iterating, I mean, you mentioned it, but coming back to the same stuff and going, with new information, new customers, new behaviors, even change in tech, like is still the best way to do it.
Yeah. So from a UI UX, quick and easy. But when you start building systems and infrastructure, that architecture is critical, because shifting that direction
the UX
is going to totally, and it's going to also create a backlog of work that that will require months of refactoring and reworking in order to shift it in a certain way. And I think we didn't get to touch on it, but this is my second venture. And I think those were my mistakes in my first venture. Exactly what I just spoke about now. Get to market without proper planning, build as quickly as possible, kind of shotgun approach marketing efforts just to see what would happen. And those things came back to bite me in the butt. It got me to a certain stage, but then prevented me from actually scaling further. And it was starting to look like a leaning tower pizza that was going to fall over. So if from taking the learnings from that business and then starting with the LayUp business, allowed us to sit back and say, okay, we're building for this use case, but let's just have considerations of what other potential options there may be, because you don't want to build in a too siloed way that then prevents you from being able to move left or right when the market needs you to. And the decision to build out a system versus a product, in my view, is the best decision that we did as a founding team right in the beginning. So you say, let's keep a wider net, It's try to think about things in a very modular fashion. So an example of the modular was that we built a firewall across each of the payment options that we have and methods that we have, card, EFT, etc., that now allows us to easily do an integration with any kind of payment provider. So we then become agnostic across any payment provider that's in the market to say, if we want to now be able to scale into Europe and add a Stripe or a Molly, or get into a different country and do Paystack or something like that, we then have an ability of not having our existing payment gateways like entrenched into our system, that now everything is running across this kind of hard coded PSP that we've partnered with. And so those, it does take experience, I think, because if I was sitting here in my first venture, I'd probably be telling myself, like, you crazy man, you don't know what you're talking about, and stuff that get to market. But I guess whoever's listening and maybe is at the start of their journey, that would be my advice, is to take a bit more time in the planning.
Awesome. I love that. Okay, great. Andrew, we're going to get into 3 lightning questions where, whatever comes to mind, you can just shout. So what would you say are the top skills or things that founders need in the early days of starting a business?
Resilience would be one. Passion and hard work.
That's a good combo. It's a good combo.
Because
I love that.
I think, this doesn't come easy. This is hard work, and some people maybe get lucky and fly through it. In most cases that I've seen, it's real commitment. It's rolling up those sleeves. It's late nights. It's stressful roller coaster up and down environments, and you have to be fully committed, fully passionate about it, which I think we might first do. And then the hard work is inevitable. You're signing up for it. So any founder that's signing up for it, know that you can't turn around and be like, oh, this is too difficult. You signed up for it. So in my opinion, just suck it up and get to it.
Nice. Okay. You are in fintech now. You exit next week and you're done with fintech. What other industry would you go into starting your next venture, and why?
Sure. I feel like I'm so fully consumed by this project that I haven't had a moment to think about it.
Well, now you have 2 seconds.
You know what? I love working with my hands, and this could be a little bit out there, and I don't want to put my foot in it, but I could build a woodworking factory or something like that, and build tables, crafting, build tables and chairs and stuff like that. But totally non-tech related. Maybe we can bring some tech into that, but it doesn't always have to be built by. I don't always have to always stay in financial services. I believe I'm an entrepreneur at heart. That's an ideas guy, and I like to solve problems. And wherever I can solve problems, I think I'll be able to add value. So we'll see. Maybe one day you'll see me creating the next.
I'll buy some wooden. I love wooden furniture, so I'll be in line. It's the first customer. And final one, Andrew, where's the ultimate holiday destination for a startup founder in South Africa?
Well, so you're probably living in the area, I would say Cape Town, but it has to be in South Africa.
No, it can be anywhere.
Well, look, seeing as I'm up in the half out, and I recently had an opportunity to go to the bush, that was probably one of the most incredible experiences. What we have on our doorstep is phenomenal. And I had 5G, blitz internet, looking over this river with elephants right in front of me. I couldn't have think of more picturesque areas to be running a business and looking at some wildlife center.
I love that. Great. Andrew, thanks so much for being I'm looking forward to see where you're taking LayUp next.
Thank you. Thank you so much. I appreciate it. And we'll chat soon.